If you're over 60 and still keeping your money in a standard checking or savings account, there's something important you need to know. The words you casually say during a bank transaction can matter far more than most people realize. A completely ordinary visit to the teller can get pushed out of the normal stream and into a compliance review just because of how something was phrased. And the part that catches people off guard is this: your bank is almost never going to explain that to you. There are certain things people say every day, innocent, well-meaning things, that can trigger an internal review automatically, sometimes before any employee actually sits down and looks at the situation. You do not have to be doing anything illegal. You do not need to be hiding money, breaking tax laws, or doing anything dishonest. That is not how these systems work. The software does not know your life. It does not know you spent 40 years teaching school, or that you're a widow, or that you've handled your finances carefully your entire adult life. It is not judging your character. It is matching patterns. And right now, it is watching for patterns created by phrases people use all the time without realizing what they sound like inside a bank. This is not just one bank's policy, and it is not limited to one region. Whether you bank at a tiny local credit union or a giant national chain, federally insured institutions across the country operate under the same broad rules and use systems designed to catch the same kinds of activity. My name is Lana Maines. I represent taxpayers before the Internal Revenue Service, and I can tell you right now, your bank is never going to sit you down and walk you through this conversation voluntarily. So in this video, I want to give you 3 things. The 3 phrases that most often push an ordinary transaction onto the bank's radar, the reason retirees get caught in this more than almost anyone else, and the 5 simple habits cautious retirees use before moving a large amount of money so it stays exactly where it belongs, under their name, in their account, available when they need it. You do not need a lawyer for this. You do not need some special elite account. And you do not need to make your life complicated. You just need to understand a set of rules nobody explains at the counter. Stay with me because the last part is the part people usually have to learn the hard way, and it is the part that can actually protect your account. Let's begin with the first phrase, the one that surprises people the most. Phrase number 1, anything that shows you're thinking about, the $10,000 line. The first danger zone is any comment that suggests you are trying to manage a transaction around the $10,000 reporting threshold. That includes things like, I'd rather avoid extra paperwork. Can we keep this under the limit? Is there a way to do this without it being reported? Even something like, I'll just come back tomorrow for the rest, can create the same problem. And yes, even if you say it lightly, even if you laugh, even if you mean nothing by it. Here's why that matters. Under the Bank Secrecy Act, banks are required to file a currency transaction report whenever a cash transaction goes over $10,000. That report includes identifying details like your name, address, social security number, and the exact amount and timing of the transaction. It goes into a federal reporting system, and in most cases, it is simply routine paperwork. Millions of those reports are filed every year for perfectly normal reasons. What many people don't realize is that the real concern is often not that routine report. It's the other report, the one you are never told about. That one is called a suspicious activity report, and unlike the currency report, it does not require a transaction to hit any specific dollar amount. A transaction for a few $100s can trigger one if the bank believes the behavior around it raises concerns. And if one is filed, the bank is not allowed to tell you. That is why talking out loud about staying under $10,000 can be risky. Once you frame the transaction around that number, it can sound like structuring, deliberately arranging transactions to avoid reporting requirements. And structuring can create legal trouble even when the money itself is completely legitimate. That sounds extreme, but this is not just theory. There have been cases where business owners and ordinary account holders had funds seized because their deposit patterns repeatedly stayed below the reporting threshold. Some eventually got their money back, but only after long, expensive fights. In some of those cases, no criminal charge was ever filed first. The money was taken, and the burden fell on the account holder to prove the funds were legitimate. The rules have been tightened over time, and there have been reforms, but the central lesson has not changed. The easiest way to avoid being misread is to never talk about your transaction in terms of the reporting threshold. Phrase number 2, using words that sound like a scam, even if it's real. The second phrase category catches people because it punishes honest explanations. This happens when you volunteer details that happen to sound exactly like the language used in fraud or elder scam cases. For example, my grandson is in trouble and needs the money today. I met someone online and I'm helping him get home. A friend showed me a guaranteed crypto return. Someone from the IRS told me to move my money somewhere safer. Or even, Microsoft is helping me transfer my funds. Those phrases are deeply associated with known scam patterns. And that means even if your situation is real, or even partly real, the language alone can trigger a review. This can happen face-to-face at a branch or over the phone. The wording matters in both cases. Part of the reason this has become more aggressive is that financial institutions are heavily trained to look for elder exploitation. Laws were put in place that protect bank employees when they report suspected financial abuse involving older customers. In practice, that means staff are often encouraged to report first if a transaction sounds like it might fit a known pattern. And to be clear, that absolutely helps stop real fraud. But it also means perfectly lawful transactions can get caught in the same net. A retiree wiring money to a relative, sending funds after selling a car online, or moving money into a regulated investment platform may be doing nothing improper at all. But if the wording sounds like a scam script, the software and the staff may treat it that way. The answer is not to clam up or become evasive. The answer is to describe the transaction in plain, non-dramatic language. Instead of a long story, use something simple and accurate. A personal gift, a private purchase, a personal investment. Same truth, less risk. Phrase number 3, refusing to answer a basic bank. Question. The third phrase is the one almost nobody sees coming. It is not what you say about the money. It is refusing to say anything at all. Statements like, "That's none of your business. I don't have to explain my own money. Why do you need to know that?" Legally, I understand the feeling behind that. It is your money, and people do not like being questioned about it. But inside the banking system, that kind of refusal often becomes the issue. Banks are required to understand unusual activity on an account. So when a teller asks a routine question and the customer becomes defensive or refuses to answer, that refusal can itself become the red flag. Not because you've done anything wrong, but because unexplained activity is exactly what the system is designed to escalate. Imagine 2 retirees each taking out $9,000 to pay for the same roof repair. One says it's for a home repair, and the transaction is finished in seconds. The other says, "That's between me and my contractor," and suddenly the exact same withdrawal may draw extra attention later from the bank's fraud or compliance team. It does not matter if you've banked there for 30 years. It does not matter if the branch manager knows your name. Those personal details are not what the software is measuring in that moment. So here's what I want you to do. Most seniors are already eligible for exemptions, tax breaks, refunds, and financial benefits they never claim. I've organized them in one place, state by state and form by form, so you don't have to spend hours sorting through government websites. It's called the Senior Exemption Playbook, and it's in the first pinned comment below this video. One tap, and you'll have it. But stay with me, because the next part is the most useful part of all. The sentence that protects you in almost every one of these situations. What should you actually say in the moment? The answer is simple. One short, truthful, boring sentence. Not silence, not a full backstory, just a plain answer. And that brings us to the 5 habits careful retirees use before any large transaction. The 5 things careful retirees do before a large deposit or withdrawal. The first thing they do is decide ahead of time on one brief, honest explanation. Something like, it's for personal expenses. It's for a home repair. It's a family gift. That's it. No comments about thresholds, no mention of paperwork, no off-the-cuff explanations invented under pressure at the counter. Decide on the wording before you leave home. The second thing they do is let a transaction above $10,000 be what it is. If the amount goes over the reporting threshold, they allow the routine form to be completed without turning it into a discussion. That paperwork is normal. Treating it like a secret is what creates suspicion. The third thing they do is avoid language that sounds like a scam script. They don't dramatize. They don't overshare. Instead of saying online stranger, they may say private purchase. Instead of crypto opportunity, they may say personal investment. Instead of my grandson is in trouble, they may say family support or family gift. The substance stays honest. The wording stays calm. The fourth thing they do is answer routine questions without refusing or arguing. One sentence is usually enough. If the conversation starts to feel intrusive or excessive, it is far safer to politely ask for a branch manager than to shut the teller down. Refusal tends to create more problems than the original question. The fifth thing they do is bring paperwork when the transaction is significant. That could mean a bill of sale, a gift letter, settlement documents, estate papers, or anything else that explains where the money came from or what it is for. If the bank asks, you already have support ready. And if you know something large is coming, an inheritance, a legal settlement, a property sale, calling ahead can prevent the surprise factor that triggers so many reviews in the first place. If you're looking over your own account history and worried a pattern might draw attention, that is also the time to speak with a qualified enrolled agent or tax attorney before you make the next move. That is exactly the framework I use when helping clients prepare for major banking transactions. The real point behind all of this. Let me pull the whole thing together. The common thread in all three of these situations is not criminal behavior. It is pattern recognition. These systems are not reading your intent. They are reading your wording, your timing, and your transaction behavior. And a handful of everyday phrases, said by good, honest people, just happen to resemble the patterns the system is trained to escalate. That means the solution is not secrecy, and it is not talking too much either. The safest approach is a short, ordinary, accurate explanation delivered calmly, the same way you would describe the transaction to any reasonable person. You are not being asked to lie. You are not being asked to act cold or suspicious. You are simply being smart enough to explain a legal transaction in plain language that does not accidentally trip an automated alarm. That is the difference between answering a question and launching into an explanation, and bank staff are trained to notice that difference. Nobody at your bank is going to prepare you for this ahead of time. The teller is not going to explain why certain wording matters. And once the system decides something looks unusual, your good intentions and long history with the bank may not protect you. There have been people with completely lawful money who spent years trying to recover frozen or seized funds because their activity matched a pattern the software was designed to catch. They were not criminals. But once the account was flagged, that did not matter nearly as much as they assumed it would. That is why the burden falls on you. The good news is that protecting yourself is much simpler than the system that can flag you. You do not need magic words. You do not need a complicated strategy. You just need one true, plain sentence, a little preparation, and the discipline not to say more than necessary. That alone can save you far more trouble than most people realize.